What are rental losses? You'll have a rental loss if all the operating expenses from your rental property exceed the annual rent and other money you receive for gross rents. But there are limits to these losses. So let's say you're a landlord with an adjusted gross income of $100,000 or less. Then, you may deduct up to $25,000 in rental real estate losses per year. However, the rental losses are phased out if your adjusted gross income exceeds $100,000 and eliminated entirely if your income exceeds $150,000. So that means the current year rental losses are useless for high-income taxpayers. But the good news is that if you have rental property with passive losses and also have income over $150,000, the suspended passive losses are not lost forever, but rather they are carried forward indefinitely until either of one of two things happen. 1. If whenever in the future you have profitable passive income, then you will deduct the passive losses against the capital gains. Or 2. You will deduct the entire suspended losses when the property is sold. The other exception to the rental loss rules is the one for real estate professionals. This rule is unlike the $25,000 loss limitation described above. This is a complete exemption from the rules. That is, landlords who qualify as real estate professionals may deduct any number of losses from their other non-passive income. To qualify for this exemption, you or your spouse must spend more than half of your total working hours during the year as a real estate self-employed professional and work at least 751 hours as a realtor. These are just few examples that can help reduce your tax. Visit taxden.com to get your free consultation and start your tax preparation today.